Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address is rshaw@fxcm.com, and today is Friday. It's the 1st of July 2022, and I'm just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments. Hey, Howard. Morning. Yeah, exactly. So Howard's saying it's start of the tax return day in ZA. Yeah. Here's the market commentaries disclaimer. Going to keep that on screen. Hey, Anna. Hey, Rob. Morning to you guys. Rob, took a look at your emails this morning. The first two I'll need to address at a later stage. The last one I think makes a really interesting discussion, and I thought we'll discuss that for this webinar. See if we can come up with something sensical there. Here is our references, Market Scope 2.0. We'll start off with CNBC.com article for the European market, and then we may consider TradingView. What I'll do is I'll just put this up on the screen in the meantime. I'll also talk about this in a moment, but I think let's go through to the CNBC article and just see what is in the media that we need to be aware of. The article reads, European markets set to retreat as caution persists after worst quarter since 2020. European markets are set to pull back on Friday after suffering their worst quarter since the onset of the COVID-19 pandemic as inflation and interest rate hikes continue to weigh on sentiment. The Pan-European Stock 600 index closed the second quarter of the year on Thursday down 9%, the worst three-month period since the early stages of the pandemic in 2020, and was down 16.6% year to date. Global market sentiment remains gloomy as the war in Ukraine shows no sign of abating, and inflationary pressures continue to mount, prompting central banks to embark on aggressive monetary policy tightening and exacerbating fears of global economic slowdown. Shares in Asia Pacific were lower overnight, with Japan's Nikkei 225 leading losses in the region after the Bank of Japan's quarterly business sentiment survey posted a sharp decline in the April to June period. However, China's manufacturing activity expanded at its sharpest rate for 13 months in June, boosted by resurgent output after the easing of COVID-19 lockdown measures. US stock futures also retreated in early pre-market trade after the S&P 500 closed out its worst first half performance since 1970, dropping 20.6% year to date by Thursday's close. Back in Europe, Reuters reported Thursday that the ECB will on Friday begin a process of buying bonds from southern European nations, including Italy, Spain, Portugal, and Greece. The ECB will reportedly use the proceeds from maturing German, French, and Dutch debt in a bid to cap spreads between the respective borrowing costs. On the data front, a flash Eurozone June inflation reading is due Friday morning, along with the manufacturing PMIs for Germany, France, Italy, and Spain. All right. All right, so we'll just start off. I want to just keep an eye on the Euro US dollar, because again, it's curling around. I just want to keep an eye on the EMAs here. Yeah, so I don't have a position on it at the moment, but I'm looking to see if it's something that is potentially viable. Euro daily looks to be coming back into the zone C, and we're getting a potential rolling over of the stochastic, and the weekly chart looking very fragile as well. The one sort of point I think that we need to just keep an eye on is the support bit. At the moment, the momentum seems to be quite firmly to the downside. So this is kind of what I'm looking at. Personally, I'm not sure if I'll take a trade here or not, but just wanted to show you guys. All right, there was an email sent from Rob this morning. I thought it was a really interesting email. So he sent a table with the forecast for the S&P by year end, and it's got all the various banks. And what I did was I just threw it into an Excel spreadsheet. I haven't really analyzed the spreadsheet because I only received it this morning, so I haven't really given it that much thought. So we'll see if there is any data to talk about here. But just to give you an idea, so the first column here, this is actually Bank of America, this is Barclays, and there's a whole group of obviously reputable banks, JP Morgan's. This is JP Morgan here. This is UBS. So the idea here is let's bring up the S&P, and let's just get an idea of what the banks are saying here. All right, so you can see trading at 3753 at the moment. 3753. This is the weekly chart. If we go back to the spreadsheet here, let's just go through the columns. This column here, this is what the forecast was at the beginning of the year. This was the adjustment at the end of March. This is their adjustment as of yesterday. Okay, so Bank of America started the year suggesting a target of 4,600. They kept that for the first quarter. So at the end of the first quarter, they kept it. At the end of the second quarter, they have adjusted it. So this is sort of the beginning of the year. Again, slightly down at the end of the first quarter. And then these guys, which is Barclays, kept it at 4,500. So what can we see here? So the first thing perhaps we want to do is just get an idea of what's the averages here, because you know that they are varied. So this is the average. The average target at the beginning of the year. So the average target at the beginning of the year was 4,909. The average target at the end of the first quarter was 4,838. And then the average target as of yesterday is 4,482. So this over here is slightly different, but I think we can work off the mean here. Let me just give it some thought. All right, so the dispersion is not too bad. We can use the mean here. So what the median actually does, if there are outliers, it will make adjustments for the outliers. So I don't think we need to. I think the dispersion's okay. Take a look at the standard deviation of the forecast. So what we're basically saying here, okay, so how many have we got? We've got 1 through to, so we've got 16 forecasts here, and there is an average. Okay, so there's an average of the 16. The average at the beginning of the year say that we're going to probably end around 4,900 roughly, and out of the 17, 68% of them would fall either to the left or right, plus or minus 231. Okay, so that's kind of, so 4,909 with sort of a 68% say chance of being within 231 points to the left or right. And then this standard deviation, this percentage standard deviation is the standard deviation over the mean. So there's a sort of a 5% dispersion around the average. That was pretty much consistent at the end of March. The dispersion has increased slightly. The dispersion has increased from 5 to 7% slightly here. So what are we saying now? So let's just understand. So the average has come down to 448. So the average consensus of the 16 is that we should end round about 4,482. Yeah, this is the forecast for the end of this year. That's right. And then with an error factor, not an error factor, it's not quite the right word, with a dispersion to the left and right of about 325 within the sort of first standard deviations. I mean, it's pretty powerful stuff there. Let's just take a look at a few of the other sort of data which I think is interesting. So this is the percentage change of the consensus between March and the beginning of the year. So Bank of America made no change. They kept it at 4,600, and that's why it's 0. Here these guys changed it from 4,000. This is Barclays. They changed it from 4,800 to 4,500. So they dropped it by 6%. So this is measuring the change in their forecasts for the first quarter. The column G is the change of forecasts from the beginning of the year to June. Okay, and then of course this is the change between June and March. So this measures the change for the second quarter. This measures the change over the first half of the year. I hope that makes sense. So let's just see if we can get some any information there. So the change from the let's change it to March. The change from March to June, the average change was 7% down over a 3-month period, with a standard deviation of 5%. Basically, it could go up or down by 75 basis points. All right, so it's a slightly different reading to the first 3 columns. The reason it's a different reading to the first 3 columns is that these are values and these are percentages. So that's why I've left these as sort of absolutes and not as percentages. So we kind of can get a movement around the percentage, but the change over the first half is at roughly about 9% down. So over the 6 months, forecasts have come down roughly about 10%. Okay, just shy of 10% is what we're seeing here. So what does it mean? Well, I think first of all, it's certainly telling us the direction that the forecasts are heading. So the forecasts are heading south. That's the first thing. There's a momentum to restate the forecast, if that's the right word, or to infer a lower S&P per the year end. So there certainly seems to be less bullishness now than there was at the beginning of the year. That makes sense. Okay, that makes sense. That makes sense that we are less bullish. But what I think we need to kind of ask ourselves is, what does the market need to do to reach average forecast or median forecast? Considering that we are at 3745, that's quite a big jump. Let's just put the median. Let's put the median. I beg your pardon. So the mean is at 4482. So let's just pop that in. All right, so we want this at 4482, and just to make it red and thicker. So this is kind of the median, what the market's saying. This is the median forecast. So let's do a little bit more math here. Okay, let's make this green. So we have the green, targets at red. All right. So what we have here is a forecast that's inferring an appreciation of 482 minus 3749 divided by 3749 equals, okay, so we're looking at about roughly a 20% appreciation from here over the next 6 months according to forecast. Okay, so let's just put that in. Okay, and the obvious question is, not the obvious question, the obvious statement is, well, we don't want to miss that out. So is it worth turning bullish now? And can we take advantage of potential increases here? And the answer is, I don't know. But let's see if we can kind of make some suggestions. All right, just a couple of comments here from Anna. What I find interesting is that there are large differences in opinion. So you can't just listen to one bank, okay, and take it for gospel. So yeah, so we obviously what we try to do, just trying to get some sort of mean consensus, and we'll work off that. And we're taking actually the lower of the mean median, right? So the median would be, so we're even adding a sort of, let's just say a conservative aspect to it. And then Anna also saying, what are they basing the optimism on? And I think that is certainly the key question. Thinking about that, so there is a possibility. There is a possibility here that we can potentially explore. it is as follows. I'm going to bring up the US 2-year here. All right. So this hasn't updated yet, this Fed's fund rate. I'm pretty sure I'll update it soon, but let's just, I think it's around about 175 now. Let's just put that in. Let me just make sure we're right here. Okay, so what we can perhaps suggest is that the Fed is playing catch up. We've said that previously. They still look to be behind in terms of the US 2-year. There's a very strong correlation here. In fact, let's add in a correlation coefficient. And you can see we, by and large, except for very sort of odd, sort of small, maybe not so small over here, but some odd anomalies where it goes to the downside. You know, I reckon we can say like 80% of the time we've got a pretty strong positive correlation. And this reading over here is not quite updated yet because it's this Fed's funds rate hasn't been updated here, but it's fairly strong at even here at 84%. So the correlation between the US 2-year and Fed funds rate is something that we can look at here. The obvious question is how aggressive is the Fed going to be? And either the Fed funds rate, which is this black line here, is going to move up towards the 2-year, or the 2-year is going to come down towards the Fed funds rate. And I think the way that this graph converges makes a big difference in terms of what we're talking about this morning. If the convergence takes place because of decline in US 2-year yields, then possibly the pessimism that's been discounted into the market is overdone. And if that pessimism is overdone, perhaps the market correcting moves us back towards the 4482. Okay. Of course, if the 2-year carries on moving up, that's going to make the case that we reach 4482 a much tougher ask. So 4482 on a weekly chart. On a weekly chart, we've got to understand that we are working on a fair lag here. We're not going to be too nimble with it. What do I mean by that? Well, by the time we understand if we have an uptrend here, the bottom's gone, right? So you'd have sort of a 1, 2, 2, 3, and kind of something like that. So when we around here is, let's change this color here. Keep it red. Okay. So by the time we reach this level here, which is around 4,200, we've given a lot of the gains away. Let's just work out the percentage change from that level. 4482 minus 4200 divided by 4200. Okay, it gives us considerably less to work with. So this over here is around about 6.7%. 6.7%. Just sort of assuming this is obviously an assumption. This is a trajectory. The trajectory may be shorter, kind of get something like that. And then this would come down like so. So, I mean, we just really just thinking of how a trend might unfold. So there will be a lag here. There will be a lag here in terms of the peak and trough analysis. Perhaps the daily chart may be something that we can look at to speed up potential signals here. So that's kind of where we're moving next. The idea here is going through to the S&P is, well, what about the trend here? 1, 2, 2, 3, 1, 2. Okay, and then we can put this in over here, and that gives us a slightly more timely type of signal here. So remember, we are on 4482. So let's see what we got here. 4482 minus, let's put it at 3950 divided by 3950. That would give us 13% still to play with. So what's the basic idea is it's very difficult to call a bottom. Very difficult to call a bottom. If we give the banks forecast any merit, okay, I would still suggest the market has to prove itself, perhaps one way or the other. And I think that perhaps having some sort of peak and trough formation, suggesting that we have moved from a negative trend to a positive trend, is something that we can potentially do. The other way that we can do this, of course, is wait for the candlestick to move into zone 1. And once we're in zone 1, if it sticks and stays in zone 1, well, then we can probably be moving towards a 4482. That's one way to look at it. The other way I would suggest is momentum. So if we can get the stochastic moving upwards this direction, I think that would say a lot. I think that's say a lot. And I think that if we get the weekly momentum, given that this is going to take some time, one would think from 20 to 80, what we can do perhaps is use the 50. So when do we cross above 50? Because then that would be onto the bullish side of the range. if you want to be more aggressive, well, then maybe set it at 40. Okay, so when do we get across 40? So when the momentum starts picking up and we're above 40, or maybe the market is starting to recalibrate in terms of perhaps too much pessimism has been priced in. Now, what we're doing here is we're making very dangerous assumptions here, and the assumption is, of course, that the interest rate here, okay, is due to converge. I think that's something that we need more evidence of. Okay, but that is sort of it's a what if type of scenario. Okay, it's about what if in terms of which way this moves. One thing to note is that the PCE, core PCE for yesterday did come down. So the inflation is starting to moderate. And you know what happened after that came out? There was a big movement in the US 2-year. Okay, it broke down below 3%. Okay, so it did come down. So I guess this is probably the mechanism that we need to keep an eye on. Those were my first thoughts. I probably got to give more thought to it. We're only really thinking about the interest rates. There's another aspect to this as well. So it's sort of a multi-dimensional problem. It comes down to the time value of money equation that we've mentioned before. So let's just bring that up. All right, I'm going to just delete this. We don't need this for now. Coming back to your comments in a moment, Anna, I see them. Let's just put in some variables here. So what we're looking at is present value equals, I'm going to put a variable of dividend into this, okay, and I'm going to put it over 1 plus interest, okay, and we're just going to keep it at that. I won't put in any time variable or any sort of exponent. Let's just keep it at that. Let's just redraw this. Okay. We'll just keep it very simple. Let's just call it interest. Could probably even lose the 1, but it doesn't matter. Let's keep it as that is fine. And let's just call this present value. Okay. Let's just understand the interest, what we're talking about in terms of interest. So let's just assume a dividend of 100. Okay. And so the market had a 2-year over 3%. So let's put this over 3%. Okay, so we'll put it as 1.03. All right, and let's just get a present value off of that. So I get 9708. All right. Now, what we do see here is it's now dropped to 2.9. So let's just make that adjustment here. So let's just keep the dividend in at 100. And let's change this now to 1.029. Okay, let's see what we get here. So we'll go 100 divided by 1.029, and a slight change here, but it will make the point. I get 97 point. I'm going to just round it up, okay, to 0.2. So you can see that the fact that the interest rate has dropped from 3% to 2.9%. We'll take a look what's happened to the present value. Your present value improves from 97.08 to 97.2. In other words, your present, as the interest rates come down, your present value increases. Well, that's one way that we may get to 4482 if the interest rates are not getting to the terminal value over 3%, or maybe we overdone. As that adjusts, then potentially we get back to 4482. Okay. However, we're looking again. We've got to understand that there is a shift going on in the market at the moment. So let's just talk about that shift. Okay. So the shift is from inflation to recession. Okay. So then the obvious question is, well, how do we model recession into our time value of money? And that's going to be this variable, dividends. So what could potentially happen with recession is that dividends start dropping. Okay. Why would that happen? Because payout ratios are generally consistent among periods. Generally, so if your earnings per share comes down because you've gone into a recessionary period and your payout ratio remains consistent, well, then your dividends per share comes down. Well, that's going to then act on your present value downwards. So there is a lot happening between the numerator and the dividend, the numerator and the denominator here. And as the market discounts the top and the bottom, we're going to get some sort of present value. It's difficult to kind of understand, well, which is going to be the bigger influence, numerator or denominator. If the bank's forecasts have anything to say about it, well, then perhaps the interest factor has the bigger influence, and they would suggest that the interest factor is not quite as dire as we think. So that's kind of what we've got to start assessing in terms of the data. Is the pessimism overdone? Are we seeing some sort of relief on the sort of recessionary side? That's the numerator, and on the tightening side, that's the denominator. So that's kind of what we need to start thinking about, Rob, in terms of the spreadsheet. But at the same time, I think that we need to look at some sort of rule to see if the market's improving price-wise. And I think that's a 40 line here in the SPX is doable. Maybe even if you want to be even more aggressive, drop it to 35. Do we get into zone 1, or do we get a higher peak and trough? So those are kind of what we can look at. But to get in too early is something that you've got to ask yourself, am I willing to take the risk? So what you effectively are saying is that the banks have given me a forecast that's 20% higher than we are. I'm comfortable with that. There is a huge opportunity for reward here, and I don't mind taking the risk, but risk reward positively correlated, go hand in hand. Higher reward, higher risk. So that's what we've got to come to terms with. Are we willing to be wrong. Okay, and that's I think that's probably a key focus. It's not going to be an easy question to answer, but I will say that the risk here is very high. And I think if you had to have a choice between risk and reward, which one to kind of put more of an emphasis on, there's no question it should be risk. There's no question it should be risk. So that's kind of, I think, where we are for this at the moment. I just want to go back to a few of the comments here that Anna's been writing. They've been really good. If anybody else has got comments, go ahead and type those in. Okay, so the first point is a terrific point. By the time we had established an uptrend after the pandemic crash, we had missed a large part of the rise. And I would agree with that, but I'm okay with that because there were still lots to come after that. Remember, the way that we analyze trend, and I would say how anybody analyzes trend, is that you're always going to be late to the party. Okay, the reason you're going to be late to the party is because of the definition of trend. The definition of trend requires effectively 4 points. Okay, so you've got point 1, point 2, point 3, point 4. And without the 4 points, you don't have a trend, but it's going to take time to get the 4 points. By the time the 4 points have materialized, the trend's already started. We've missed the beginning, and we've got to be okay with that. And we've got to figure out, and I guess hope that there is still a lot left in it. And the pandemic, the movement after the pandemic low had a lot of meat to it before it capitulated. So you kind of want to capture this part here. That's really the idea, because how do you capture that or that consistently? And again, I would say that there are about nobody that can do it consistently. I'll say just about nobody can do it consistently. The only people that would do it would be the guys that are kind of lucky, So that's that. So yeah, we were late to the pandemic low. We've got to. I think that we can only be happy with that in terms of what we're aiming to do. If you're aiming to get cycle lows or cycle highs, setting yourself up for failure, and most probably, and you're setting yourself up for an extremely difficult job. And the only way really to do it is to start really dabbling in esoteric methodologies. So your esoteric methodologies, referring here specifically to technical analysis, would be you're looking for Elliott waves. You're looking at kind of your fibs and all that kind of stuff. So that's kind of my thinking there. Let me just see the next. What about the S&P ratio reaching fair value? All right, so I said I'll bring it up today on the chart, which I still didn't. I didn't get the right ticker. Let me just see if I can find that. I'm begging your pardon. Just bear with a moment. Understanding that we've gone a fair amount of time. Just bear with me a moment. I'll just see if I can, because again, I think Anna's asking very pertinent questions here. Just bear with me a moment. I'm still here. I'm begging your pardon. Just give me a moment. All right, just waiting for. Here we go. Waiting for some data to download. It's taking a bit of time. I'm begging your pardon. All right, so I'm just going to find it in my Word document. Okay, I'm begging your pardon. It's just opening now. I'm sorry, I sort of went silent for a moment. Just while that's opening, let me just see some more questions here. Very nice, Anna. Anna's just saying, when she first started the webinar, she wanted to learn technicals, but she's now going much deeper, watching videos on economics, geopolitics, and really, that's awesome. Thank you for saying that, Anna. It's cool. She's also asked, have we seen capitulation or panic selling? So again, this comes back to Rob's point here. Perhaps we have seen it, and that's why the banks are saying we see 20% ahead of us. I think. All right. I'll come back to those in a moment. Let's just take a look at this PE ratio, because I think terrific point there. All right, so again, this is from our third quarter report. I am of the opinion it's going to be hosted today. I'm of the opinion it's going to be hosted today. This does come from TradingView. I can't find it, but so Anna's asked, well, what about the P ratio? Aren't we at sort of fair value, or are we near fair value? And this PE ratio goes back to 1872. So just to give you an idea of what we're looking at here, and it actually has quite a nice, I think, quite a ordered dispersion around the mean. That's the mean's this blue dashed line up until about the late 90s, and then we go into quite a different, I think, mindset in terms of perhaps the whole movement into the information age has disrupted the dispersion here. But you can see that we have, instead of moving up to within the first standard deviations, which is these green lines. Now, distribution theory, statistics says you should really be oscillating between the green lines 68% of the time. You should only reach the orange line 13% of the time. And I mean, to get past the red, we're looking at like I think it's 0.02% or 0.2%. It's like we shouldn't, but we've hit it 3 times over since the tech wreck, which is way too often to be sort of for us to be comfortable with that. Something's happening here. There's some sort of statistical evolution that seems to be taking place with this probability function, you know, or probability distribution. The point being, though, that every time we've hit this 3rd standard deviation, there are serious pullbacks towards the mean. Serious pullbacks towards mean. So we hit it tech wreck time, bang, we hit the mean. We hit it global financial crisis time, bang, we hit it pulls back. We now hit it into, I don't know what to call this, let's call it unlimited QE time, and now we are moving back towards the mean here. Now, the fact of the matter is, and we've got to really acknowledge is that two pullbacks out of a history since 1872 can really be flukes. You know, there's no real evidence there. But assuming, taking the gigantic leap that we are going to see a pullback towards the mean just because it's happened twice, well, that would suggest we've got more movement to go. So we're looking here at the PE ratio. We're looking at the PE ratio. So what we want to do here with the PE ratio is, let's just say the PE ratio mean is 10. So we're just going to go like this. PE equals 10. That's our mean. And what we're going to say is that we are currently at 12. Current PE is 12. Okay. Now we think we're going to go back to 10. Why do we think we're going to go back to 10? We think we're going to go back to 10 because the last times we hit the 3rd standard deviation, we pulled back all the way to 10. So, well, you know, it's probably, if it's going to happen, it's probably a good time to happen now. Now, if we head into a recession, okay, if we head into a recession, the earnings per share forecasts are going to be adjusted downwards. Okay. Okay. So now let's work with this 12. Okay, watch this. We're going to work with 12. Okay. So let's just say that to get 12, the price is 24. Let's just say the price on the stock market, again, we're just assuming is 24, but the earnings that we're dividing that price with must be 2, right? Must be 2, and that is giving us the PE of 12. Now, remember, we want to get down to 10. We want to get down to 10. That's what we suggested. But we're also saying, well, if we're going into a recession, and if businesses are already not doing as well as previously, then these earnings per share need to come down. Then they need to come down. Now, I think everybody follows that. If you don't, just let me know. Okay. So now let's just assume it goes from 2 to 1. Let's say it goes from 2 to 1. Okay. Well, what's your PE ratio? That's 24. But we need to get to 10. Okay, but we're moving in the opposite direction. We've just moved from 12 to 24 instead of from 12 to 10. Okay, so the fact that the earnings per share is adjusting downwards and we want to get to 10, well, how do we get to 10? Okay, how do we get to 10? Well, there's only one way for us to get to 10. It's for the 24 to go through to 10. That's the only way. In other words, we would need 10 divided by 1 to equal our mean. So what are we saying here? We're saying here that the earnings per share has to be adjusted downwards if we are going into a recession. But if we want to get to 10, well, then we're still too high. And if we're still too high, that's your capitulation right there. Now, we're making huge assumptions here. This is not necessarily how it's going to work out, okay? Because we've only got 2 previous data points. 2 previous data points is simply not enough evidence, okay? But assuming it plays out like that, then if we're still going to get the capitulation, then the banks are being highly optimistic. So the idea here is, okay, and I think this is the way that we're going to have to sort of settle this. We're going to have to understand that what we're really discussing is, and I mentioned reward to risk. The banks are saying you've got 20% here, potential reward, okay? But the risk is big here. Risk is big. Which side are you going to give the emphasis to? Okay, risk always wins. Always. Okay, so we're going to have to monitor this, and the way we're going to do that is we're going to be watching, I think, the stochastic. Does it get over that 35.40? We'll be watching the daily as well. Does it get into zone 1? Okay. Just reading a few of the comments here, very interesting. I think we've gone over an hour here, just by the way, so we've really put it, so I think what we'll do is we're going to cap it here. We'll carry on the discussion on Monday. Clearly, this is ongoing. There's no closure with this discussion. Are we heading to that mean by the banks? Are we heading lower? And you know, I'm glad that Rob sent that table this morning, because we need to try and get on top of it. Okay. All right, guys. Thanks, Rob. I'll take a look at your other 2 emails as well and get back next week. All right, guys. Let's wrap up here. Have a really good weekend, and we'll catch up. Next week. Thanks, guys.